So let's move to a kind of different issue. So let me say good morning, everyone, again. This is the fourth session of this meeting, and is dedicated to the new industrial developments and the evolving architecture of international trade. We will be introduced to this fascinating topic by Ana Maria Santacreu. She will present her paper with several other authors. The paper is called Recent Evolution in the Global Trade System from Integration to Strategic Realignment. Ana Maria is an economic policy advisor in the research division of Federal Reserve Bank of St. Louis. The paper will be discussed by Diego Comin. Diego is professor of economics at the Dartmouth College. So geopolitical transformation, the aggression and intention, the aggression of Russia on Ukraine, the conflict in the Middle East, and more recently, the changes in trade policy in the US have put trade at the center stage in the discussion of many central banks, which used not to be the case. And the ECB is, and more precisely the Eurosystem, is not an exception. For quite some time, we have been reflecting on the transformation of trade pattern and on its implication for central banks. One outcome of this research effort that we have been doing at the ECB is an important report that we published last year, more or less on the same topic. And I'm glad to see that the result of our research are confirmed or speaks the same language as the paper that Ana Maria is going to present. But I don't want to spoil the presentation, so without further ado, please, Ana Maria, the floor is yours. You have 20 minutes, please.
Thank you. Thank you very much. It's a pleasure to be here. The paper I'm going to present is joint work with Florencia Iraudo, with François Cessoir, who is in the audience, and with Alexandre Gaillard. Before I start the presentation, the usual disclaimer applies. The views of this talk are my own and do not represent the views of the St. Louis Fed, the Board of Governors, or the system. So in this paper, we're going to document recent changes in the global trade system and their implications for the euro area. And as you will see, many of our findings are going to resonate with some of the discussions that we had yesterday and with the ECB's updated strategy. So let me start. Over the past decades, we see that global trade integration was mainly driven by efficiency. Countries have been sourcing imports from those countries that could produce them more competitively, either through lower costs, through higher productivity, or because they had access to key strategic materials. But more recently, geopolitical tensions and strategic rivalry has moved the focus towards resilience. Governments are now resorting to policies like diversification or reshoring to reduce strategic dependencies. And these changes are particularly important for high technology sectors, for which the risks of relying heavily on a few suppliers are significant. So what we're going to do here is we're going to do an empirical analysis to document how trade flows are going to respond to these pressures and to identify what are the risks for the euro area. Let me start by walking through the main key takeaways from our analysis. And as you will see, at the heart of many of these changes are major developments that are happening in China. So our first finding is a rise in competition from China. China has been moving from being a low-cost supplier to being an innovation-driven competitor in key strategic sectors. Second, we find selective fragmentation. We do see that the trade flows are responding to geopolitical tensions, but this response is uneven, both across countries and across sectors. And as you will see, China plays a unique role in this selective fragmentation. In the case of the euro area, for example, the euro area has been reducing dependencies from Russia, but it has been increasing dependencies from China in key technology sectors. And the third finding that we see is that there's concentrated supply chains. Europe is relying on a handful of countries for the supply of key technologies and critical minerals. And many of these countries are geopolitically distant countries. So in this landscape, there's a role for coordinated policy, both internally by deepening the internal market integration to increase resilience and foster innovation, and externally by recalibrating trade policy in an environment where there's increasing global fragmentation. So let me start with our first finding. China has become a direct competitor to the euro area, both in innovative activity and in exports. To see that, we're gonna look at a new index that is gonna measure the overlap in the sectoral composition of innovation and exports, both in the euro area and in China. We're gonna look at data on patenting activity and data on traditional trade flows to document this finding. What we're gonna do in the figure on the left is we're gonna look at the evolution of this overlap. A value of 0 in this index tells us that China and the euro area are specializing in completely different sectors. And a value of 100 means that they are innovating and they are exporting in the same sectors. What we see is that these trends are going up. That means that China is exporting, that's what we have in this black line, in the same sectors in which the euro area is exporting. And what we see in the red line is that China is innovating in the same sectors in which the euro area is innovating. And what we find in our analysis is that this is not driven by the euro area changing its focus. This is driven by China starting to specialize in those sectors in which the European Union had a comparative advantage. Now, in the graph on the right, what we see is what are the sectors that have contributed the most to this convergence. And what we see is that both in innovating activity and in exports, these are machinery and transportation equipment and chemicals. These are sectors in which the euro area had a competitive edge. Okay, next, let me walk you through one of our main indicators. This is a new measure that we have developed. This is what we call the Partner Similarity Index. It measures the overlap between an exporter's sectoral specialization and an importer's sectoral demand. So what we see in the bars on the left is the similarity index between what China exports to the world and what the euro area imports from the world. The fact that these bars are going up is telling us that China is starting to export in those sectors that the euro area has been demanding from the world. So China is moving up the value chain and is starting to specialize in high-value sectors. What we see in the bars on the right is something different. This is the similarity between what the euro area is exporting to the world and what China is importing from the world. These bars are going down. What that means is that China is starting to import less in those sectors in which the euro area has been exporting to the world. And this is mainly driven by transportation equipment. This is telling us that China is starting to specialize in those sectors that the euro area was exporting. So what this shows us is that there is an asymmetric and growing trade alignment between China and the US. While China is positioning itself to export in sectors in which that the euro area is demanding, is starting to meet the demands of the euro area, is also starting to import less in sectors that the euro area was traditionally exporting. Okay. So these asymmetries are telling us that now China is getting access to the euro area, where the euro area is losing access to the Chinese market. And these asymmetries are not just theoretical. Between 2004 and 2024, the trade deficit of the euro area with respect to China increased by a factor of 3. So the main message from this figure is that trade is not vanishing. Trade is becoming more uneven and is becoming more asymmetric. And this is what we call selective fragmentation. And this is what I'm going to show you next. So the next question that we ask is, are trade flows responding to geopolitical tensions? And how have those responses changed over time? To answer the question, we're going to use a well-established gravity method that is going to allow us to estimate the association between trade flows and geopolitical distance. So here what I'm going to show you is how trade flows are reacting to geopolitical tensions over time. Each of the dots that you're going to see in these two graphs represent the estimated effect of geopolitical distance on trade flows. A negative value implies that trade flows decrease between geopolitically distant countries. And the bars around these dots are telling us how precise these estimates are. What we're going to see in the left figure is that when we include all the countries in the world, the effect of geopolitical tensions on trade flows have been moderate, but they have become more important in the last two periods. So there is geopolitical tension that is impacting trade flows that have become more important more recently. Now, what is really new and is really striking is what happens when we remove China from this analysis. That's what we have in the figure on the right. In this case, what we see is that the effect of geopolitical distance on trade flows has been stronger than when we have all the countries, and it has started earlier. So this shows us that China still plays a central role in supply chains, and in fact, it has expanded exports across many countries, regardless of their geopolitical alignment. That's what we see happening with the euro area. The euro area is relying more on imports that are coming from China. So this is what we're calling selective fragmentation. There are studies out there, the IMF has some studies where they also find this geopolitical effect, this effect of geopolitical tensions on trade flows. What is really new here is that we're looking at how this is evolving over time, and we're really looking at this effect of China and the effect on selective fragmentation. So now let me zoom in into this idea, and let me compare how the euro area is reacting to these geopolitical tensions and how it compares with the US. So to do that, we're going to compute changes in import sources, both for the euro area and for the US. So we're going to look at what are the countries that are gaining and losing access to these two countries. We're going to plot here the top gains and the top 3 gains and the top 3 losses. So let's focus on the panels on the left. On the top row, you're going to see the effects of the euro area, and in the bottom panel, we're going to see the US. What we see here is that both the euro area and the US are reducing their dependence from China, but their strategy towards, from Russia, but the strategy towards towards China, it's being different, and that's what we see in these red bars. So while the US is decoupling from China, is decreasing its reliance in imports from China, what we see is that the euro area is starting to import more from China. Now, what you see in the middle panel and in the right panel is the sectoral decomposition. In the middle panel, you have changes in import shares for the euro area in high technology sectors. There are big differences between the US and the euro area. The US is decoupling from China in high-tech sectors. The euro area, as you would see in the red bar, is really increasing its reliance from China in these key technology sectors. What you see in the right panel is what's happening with low technology sectors. In this case, both the euro area and the US are decreasing their reliance in imports from China. So fragmentation is happening, but it's asymmetric both across countries and across sectors. The euro area is starting to depend more on China for imports of high technology sectors. So the question now is, how diversify our supply chains in the euro area, especially supply chains in these key technology sectors. So that's what we're going to do next. To do that, we're going to compute how concentrated are the imports of advanced technology products, both in the euro area and in the US, for comparison. So here, we're going to compute standard measures of concentration. This is a Herfindahl index. Values above 0.25 are indicating that these countries are importing these key technology products from just a handful of source countries. Each dot in the graph is a technology product. Higher values indicate higher concentration. What we see here when we compare the euro area in the horizontal axis with the United States in the vertical axis is that the numbers are different, but the message is very similar. Both the euro area and the US are the imports of key technology products are heavily concentrated in a handful of countries. And this creates vulnerabilities to supply disruptions and geopolitical risks. If one or two countries face disruptions because there's a shock, because there's a policy action, or because there are geopolitical tensions, that's going to reduce access to key products that the euro area needs to produce. So that brings us to policy. If the euro area cannot reduce external dependencies, especially in those inputs that the euro area cannot produce, then the focus has to change towards what it can control, and that's deepening the internal market integration. Now, this idea of deepening the internal market integration is not a new one. It has been in the policy agenda for many years. But we think that it's important to bring it back, especially given all these trends that we have documented. So let me clarify why we think this is important. These trends that we have documented on the rise of China are creating a dual challenge for the euro area. First, there's a substitution risk, because China now is competing directly in high technology sectors, which can displace European firms through scale and through price. Second, there is what we call a complementarity risk, because China now is dominating on the supply of critical inputs that are difficult to substitute, and it's very difficult to scale up the production of these goods as well. And these risks are interconnected. If there's disruption in the upstream critical minerals, at the same time in which China is increasing the production of ready-to-use substitutes, that could displace foreign production, and the same time in which China could increase its own market share. So that brings us to the importance of deepening the internal market integration. By deepening the internal market integration, we can create scale. Having a more unified goods market is going to create scale to increase production and to increase innovation. This is the idea that size matters. This is the home market effect that was introduced by Paul Krugman in the case of trade, and that was adapted by Philippe Aghion for innovation. But second, having a more integrated capital markets is going to help channel funds towards high-risk and high-value projects. We were talking yesterday about how all these startups are going to the US to find venture capital. Having a more integrated capital markets is going to allow for capital to be better allocated and incentivize innovation. This is where the US has a competitive edge. The US has a large internal market, and it has an integrated capital market that can help reduce vulnerabilities to this type of disruptions. And we know how this has played out in practice. There is a recent paper by Laura Alfaro and co-authors where they find that China's export controls that were introduced in 2010 for exports of rare earth metals, those export controls foster innovation in foreign countries, both by creating scale and by having a more unified capital market. When the markets are fragmented, these type of responses are difficult to achieve. So that's why deepening the internal market integration can create both scale and innovation. However, as I'm going to show you next, integration has stalled since the mid-2010s. So what we're going to do is we're going to, again, use gravity methods to estimate the evolution of internal barriers within the euro area, and we're going to compare those with external barriers. What we're going to see when you look at the light blue line, and we're going to measure this in tariff equivalent units to its comparison. The light blue line gives us good news. There's been a reduction in internal barriers over time. These barriers are lower than the external barriers. That's what we see in the red line. The bad news is that this integration has stalled since the mid-2010s. So this is reflecting frictions like regulatory divergence, infrastructure gaps, non-harmonized standards. Okay? So there's been this stalling in internal market integration. So let me talk about what are the implications for monetary policy of these findings. So first, there's inflation pressures, because depending heavily on just a few suppliers, make countries more vulnerable to persistent supply shocks, which introduces more volatility in inflation. This will resonate with the ECB's updated strategy that was announced a few days ago. Global supply chains were optimized for efficiency, not for resilience, and now this model is being tested. Policies that increase resilience via diversification or via reshoring can create a stability, but it also introduces costs. So it's not like the inflation output trade-off is changing. It's becoming more complex because there are changes in the underlying structure of production and of trade that are making this type of response more difficult, are making the transmission of monetary policy more difficult because there are more uncertainties being created. The second challenge for monetary policy is the euro area heterogeneity. We find that not all member states face this type of dependencies to the same extent. So that's making the calibration of monetary policy more difficult. One interest rate doesn't fit all, and we were talking about this yesterday. And that's where deepening the internal market integration and deepening capital markets can help to increase scale and to increase innovation. So let me finish with 3 key messages from our analysis. The first one is China is not just catching up to the euro area, it's actually converging, it's becoming a direct competitor in key strategic goods. And not only that, China is increasing self-sufficiency in those sectors in which the euro area used to export to China. So we have an increase in asymmetries in trade alignment between these 2 countries. Second, there's selective fragmentation. Fragmentation is happening, but it's uneven across countries and across sectors. And despite geopolitical tensions, China still remains central to global trade. And third, there's strategic dependencies. Europe is relying on a few and often geopolitically distant countries for the supply of key technologies. So these trends are creating risks for growth, for inflation, and for the transmission of monetary policy. And the path forward is not new. Deepening the single market can help Europe use its size to create more output and more innovation. Thank you very much.
Thank you, Ana Maria. So, Diego, please, 10 minutes.
Thank you very much for inviting me to discuss this excellent paper by Ana Maria and co-authors. So this is an extremely rich paper. It has lots and lots of facts about a diverse set of topics. It's very kaleidoscopic. If you move them around in one way or the other, you get a different picture. And so my approach to understand the paper was to make my own summary about what happened. Okay? So in a one-sentence summary for what this paper is about is the following. I think this paper tries to explore the implications of China's emergence as a technological leader on industrial and distortionary policies that have caused fragmentation. And then it tries to explore, to a lesser extent, what are the challenges of operating monetary policy, especially in that new context, are. Okay? So here is my potential summary of the findings of this paper, my potential story about all these facts. First, there's been this increased competition from China in high-tech sectors, which happen to be the sectors where the European Union, in particular Germany, was a historical leader. Parentheses, that's not surprising, okay? That's a consequence of structural transformations. Economies change the sectors in which they operate. Naturally, as they become richer, China has become richer, so it has changed the sectors. And 2, the fact that innovation follows structural transformation. So you tend to innovate in those sectors where you have larger share of economic activity. I have a recent paper with Daniel Ascari from the New York Fed and Martin Mestieri that does that. Okay, so that's first point. Second point, this increased competition, this increased threat from China, together with geopolitical tensions, like Russia's invasion of Ukraine, has triggered a policy response. And the policy response has been huge. This is one of the things that Ana Maria didn't show in her discussion, but it's occupies a significant space in the paper. It's massive. There is a huge number of new policies that have emerged as a consequence of these two forces, potentially, as a consequence of those. And that has led to fragmentation, which may have implications for inflation, output, and policy making. Okay, so in my presentation, I would like to talk about three things. First, I would like to briefly mention this evidence on increased competition from China, and I would like to discuss a little bit the relevance for growth. Second, I would like to think a little bit about what are the potential drivers of the policies that have caused the fragmentation. What are, what is the rationale for these policies? And third, I would like to think a little bit more about the consequences of fragmentation for inflation. Okay, so what are the facts, the main facts? Well, first, China has increased the share of patents in the world. Okay, so patents in China has increased dramatically. Interestingly, the sectors where China has patented have overlap more and more with the sectors where Europe used to patent. Similarly, for trade, China has been changing the composition of trade towards sectors where the rest of the world imports more, like auto, machinery, and transport equipment. And Europe has been exporting more in sectors where China imports less, okay? So the Chinese are less interested in the stuff that Europe exports, and Europe and the US are more interested in sectors that China exports. Okay, now, a couple of potential criticisms about the methodologies. First, innovation here is measured by patents. This is a cheap shot, but patents are not a great measure of innovation. They don't measure the quality of the innovation. Many innovations are not patented, so that doesn't apply uniquely to this paper. It applies to a whole industry. Second, this paper tries to measure the overlap both in innovation and in exports by looking at two-digit sectors. That's too aggregated, okay? Like you would like to go thinner than that. The authors have the data. They cannot show it, but I would like to see it. I'm sure that the fact will stand, okay? So I'm not surprised about the fact. Okay. A bigger issue is, should we care about that? Is this important? Like, is this a big problem or not at all? I tend to disagree with the tone that Ana Maria used in her presentation. The tone didn't transcend the paper. The innovation is not a zero-sum game, okay? We know that. We know that innovations are non-rival, so if somebody else invents something, I don't have to invent it again. Knowledge spillovers, you cannot encapsulate them. So if the Chinese invent something, we learn all something about those technologies, and that's going to be good for everybody else. We shouldn't be upset about the fact that China is inventing stuff, okay? That's good for all of us. So what about productivity growth? Well, innovation, it's important to understand productivity growth at the aggregate in the world, but it's not important to understand productivity growth for individual firms. Most firms don't innovate at all. In high-income country, only 20% of firms do any innovation. Much more important than innovation is the adoption of technologies. And recent work with Xavi Sirera and Marcio Cruz, what we have seen is that in most firms, there is a big gap between the best technologies they have adopted and the technologies that they end up using. This gap between adoption and use of technologies explains a huge amount of the variation in productivity across establishments. So that's a margin that we should focus if we want to improve productivity at the establishment level, at the firm level, okay? Okay, so maybe this is not just about productivity or growth, maybe this is about jobs, okay? And I will talk a bit more about that. It's unclear to me what tariffs or barriers to the import of high-tech Chinese products is going to do for jobs on net. On the one hand, it's going to protect certain industries like solar panels. Now we have German solar panels. There will be workers there that will work. But on the other, there will be many sectors that would use cheaper Chinese tech products that would grow more, they would invest more, and there would be more jobs created there. So on net, I don't know what's the result, but it doesn't strike to me as a clear, as a very easy question, and as an obvious question. Okay. Furthermore, as we have seen, protecting high-tech sectors in the EU or in the US has higher level trade-offs, okay? Presents higher level trade-offs, like, both in the EU and in the US, when protecting solar panel industries and EV industries, we compromise the green agenda, okay? Because it was much more expensive now to have like green cars, like we have benefited a lot from having cheap Chinese electric vehicles and cheap Chinese solar panels to push the green agenda. Instead, we chose to protect our local industries at the expense of the green agenda. Okay, so, on the distortive, I'm doing so bad in terms of time. Okay, so on the distortive policies, there is many of them are local, others are global. They are very distinct in terms of nature. It's not obvious to me, like, what's the dominant force that drives them, okay? As I mentioned before, if you look at the geopolitics, bilateral trade flows have been increasing throughout, both within blocks and across blocks, according to the authors. And only in the last couple of years, you see a slow decrease in bilateral trade flows across blocks, okay? So that's where the geopolitical tensions emerge. If you think about what other factors may have driven trade distortions, as I mentioned just a second ago, I don't think that welfare enhancing, the nature of these distortions is motivated by welfare enhancing policies because of innovation or because of productivity. A potential argument to be made is that this is maybe driven due to welfare enhancing policies that are to protect medium skill jobs. In my view, that's not, that argument presents a fallacy, which is that in the big scheme of things, the role of trade in medium-skilled jobs is not measured, okay? Most of the medium-skilled jobs that have been lost are not in tradable sectors. They are in non-tradable sectors. And even in tradable sectors, if you look at the reduction in the share of manufacturing, for example, in the US, in terms of value added, has been much smaller than in terms of employment, okay? Which means that much of the jobs have been lost to automation, not to trade. And furthermore, a more important driver an important driver of this reduction in jobs and value added in medium skilled sectors are income, okay? Because as we become richer, we tend to buy more high income elastic sectors that are more skill intensive, okay? So at the end of the day, trade probably comes at the bottom, and yet the narrative is that jobs are destroyed only through trade, okay? That's probably not our narrative in academia, but it's the narrative in politics. And so it's very easy to shoot at this particular culprit in terms of trade. If I have one more minute, I will talk briefly about monetary policy. Basically, the point I want to make about monetary policy is, instead of commenting on the interesting points about geopolitics and supply chain disruptions, the point I want to make is that the consequences of the unraveling of the global trade for inflation depend a lot on how this unraveling takes place. If you think of it as a one-time shock, where a fragmentation emerges, surprisingly, that's going to increase the cost of production, that's going to shift the Phillips curve, that's going to cause inflation, okay? However, that's not how fragmentation takes place. Typically, the way it takes place is fragmentation is something anticipated, okay? Either because it plays out in the future and we gradually get there, as Ana Maria showed, or because there's lots of uncertainty, as we have seen in the US, and eventually we may have more fragmentation, but we still don't know when or how, okay? And so as a result, what that means is that the main force isn't going to be this shift in the Phillips curve, but there's going to be a shift, an income effect, a wealth effect, that is going to shift the IS curve. It's going to affect the real rate, which yesterday was, undermined. And that is going to cause deflation, not inflation, okay? So in my view, a big reason why we're not seeing inflation, even though we have all these potential tariffs playing out in the US, is the fact that it's affecting the real rate. And as a result, people are not consuming so much. And we are, aggregate demand is going down. And that's something that I think we are seeing in the US. Certainly we are seeing it in Europe or in Japan or Korea, okay? I would like to leave here. Thank you.
Thank you. Thank you, Diego. So, Ana Maria,
Yes.
back to you to answer to these several questions.
Thank you, Diego, for a thoughtful discussion. I just wanted to make 3 points in response. First, on the use of patents, we totally agree that patents are not a perfect measure of innovation, and definitely they are not a good measure of innovation quality. However, the way in which we use patenting in this paper is a little bit different. For us, the fact that China is now starting to file patent applications in these high technology sectors basically tell us that China is positioning itself either because China is growing and there's transformation, or because of industrial policy that is happening in China. China is starting to target these sectors and is starting to become a direct competitor in these sectors, both in innovation, but also, as we show in our paper, on export activity. So we're using patenting in a more general way, right? So China wants to put itself to become a direct competitor in this type of sectors. We totally agree, two-digit level of aggregation is very aggregated. We're actually working on refining and doing this analysis at a more granular level. My second point to the question of should we care about it, should we care that now China is becoming so efficient at producing this type of goods and innovating in this type of sectors, we agree that innovation is not a zero-sum game. Global knowledge is good. There's knowledge diffusion, and countries can benefit from this knowledge diffusion, and they can grow. But the problem now is, going back to how I started the presentation, now there is a trade-off between efficiency and resilience. And the problem now is that we are sourcing these inputs from countries that are geopolitically distant. There's geopolitical risk, and disruptions can really impact negatively production in the euro area. So we have this trade-off between efficiency and resilience that we care about. My third point is on jobs. We agree, but I think that that's more relevant for the first China shock, where we saw that China was competing in low cost, in sectors that were labor intensive. The second China shock is a little bit different. Now China is competing in high technology sectors. So if maybe there's a job displacement there, I think the problem now is on displacing production in this type of sectors.
All right. So,
Can I reply?
Please.
So, thanks, Ana Maria. I mean, I think those are great points. On the resilience, I mean, I benefit my research from studying supply chain disruptions, so I'm a big fan of them, but I don't see them everywhere, okay? And if you go back to what happened during COVID, that had nothing to do with geopolitical risks, okay? That had to do first with a reduction in capacity to produce in 2020, and then in 2021, 22, 23, it had to do a lot with a huge demand, to a large extent fostered by European and American central banks. And that was why supply chain disruptions took an effect on inflation. So should we be now more worried about China than when we were like 10 years ago? Has China changed so much in the last 10 years? I don't see that this geopolitical risk, like in terms of alignment in UN votes, or I don't see why this should be a big problem now vis-a-vis 10 years ago, personally. I understand that there is a risk, but I don't see that there's been that much developments on that. And with respect to jobs, the paper is fantastic, okay? But unfortunately, many things have changed in the last 5 months. And I say unfortunately because the paper, in a way, like cannot capture them, but also because it's unfortunate the turn of events that we're seeing in the US in terms of these barriers. And clearly the main motivation, one of the key motivations that the Trump administration has for barriers has to do with jobs. Like, I want to return jobs to the Midwest. So clearly that's salient in the narratives, at least.
All right. I have already 7 people asking for the floor, actually 8 now, so I invite everyone to be short and sharp in the questions. So the gentleman. No, okay. Then I have Jean-Pierre and then the lady in the front.
Volker Wieland, Goethe University. You mentioned or pointed out that China and Europe have become more similar in imports and exports, particularly in manufacturing, automobiles, chemicals. These are, as you mentioned, Diego, areas where Germany has an outsized presence in Europe. And I think there's an important driving factor you didn't look at. This driving factor is really the companies who produce these. So if you look at German companies, they are heavily, both all the large companies in these areas, but also all the medium-sized companies, they heavily produce in Germany and in China and other Asian countries. So a lot of these imports and exports, and becoming more similar over the last 20 years, is driven by that process. These companies are producing in both places. To give you some examples, if you want to produce a bottling manufacturing line, these are real-life examples I know about, well, you don't just want to produce that in Germany and export it to the rest of the world. We're 80 million people. You have in China already 1 billion, in Southeast Asia more than 500 million. So you're going to have to produce it elsewhere too. And ideally, you can get high value added elements, often service-related services in Germany, which are related to the manufacturing of these things. And that's part of the wealth creation in Germany. So it wouldn't be possible without this globalization, and it's driving this. If you go to the China Development Forum, all the top CEOs of the big German companies are there precisely for that reason. And of course, now they're not only producing within China and sending back parts in both directions, they're also supplying Asian markets, so it would show up in the exports. I'm much more worried not about this trend, but about, for example, seeing Volkswagen losing out in China, where it's producing on the Chinese costs, getting Chinese subsidies, but losing out to Chinese producers of electric vehicles. I think that's the worrisome thing.
Jean-Pierre.
Piero from the IMF. So I think this is a very interesting paper, and I wanted to make a couple observations. So first, the increased dependency of the EU on China, I think, is very well noted. But there is also another dependency for the EU that's on the export side that is also in the charts that you were showing. And that's maybe in part a result of the macro forces. It's a dependency, increased dependency on the US. So what we're seeing is an increased share of US imports coming from the EU at the same time as the EU has an increased share of imports coming from China. So in the work we've done at the fund on how trade flows are restructuring given increasing trade tensions, there are two stories basically. There is the emergence of what we call the connector countries along the supply chain. So these are the Vietnams and the Mexicos of the world. They're intermediated production from China to the US. But there are also what we call macro connectors. So just the fact that these trade tensions are not changing the overall trade balances, or maybe changing only the bilateral ones. So that means the flows are coming from somewhere else, maybe not along the supply chain, but that dependency is there as well. I think that's important for the EU. Second, I share some of the points made by Diego on, we ought to be careful when we are talking about dependencies. To me, what was striking last year, the CPR and Bruegel published a Paris report that was looking at this question. There was a chapter by Isabelle Méjean on trying to identify critical inputs for the EU. And their appendix in their paper has a list of the identified goods there. And if you look at that list, it starts with castor oil, and then you have things like electric blankets, camping goods, you have, air dressing appliances. Clearly, these are not things I think we think of as critical dependencies. So, and this is done with the sort of state-of-the-art technology, which are the goods that we, very concentrated suppliers, very low elasticities. You apply sort of very reasonable criteria, and you end up with a largely nonsensical list. I don't think we would want to put trade restrictions or think that we have to develop castor oil supply somehow. So I think there we have to really be very careful about what we identify as critical inputs, because that's an open door for forms of protectionism that I think we want to resist. Then the last point I want to make is on innovation. Again, echoing some of what Diego said, I think we have to apply sound trade policy principles. There's nothing wrong with another country innovating, even if it's innovating in industries that we have a comparative advantage in. It's only a problem if somehow they're putting in place trade distorting policies. And so the question becomes, how distorting are their policies? There is a good case to be made that in the case of China, there are all kinds of policies, but that's where the attention should be, and that's where the remedies should be going. Thanks.
Okay. Let's.
Nicola Fuchs-Schündel, WZB Berlin Social Science Center. So thanks a lot for the interesting paper and discussion. I have two questions for Ana Maria. So you are stressing that increasing resilience through reshoring will increase costs and inflationary pressure, and that the way out is a deepening of the single market. So to question, what do you think is the most important measure for deepening the single market? And secondly, couldn't we even rephrase it as chance, because you show that the trade barriers within the EU are still very high. The numbers are actually kind of shocking. So could it be that this kickstarts a deeper single market that could actually lower costs despite the reshoring that we do away from China?
All right, let's try to get first answer to this first section, and then we move to the next one. Please be short, because we have many people that wants to get in.
I'll try to be short. Thank you for all the questions. We agree with many of the comments that you have been making. First of all, we are not advocating for introducing trade restrictions in the paper. We're just like laying out where are the main vulnerabilities that the euro area now is facing. On multinational production, it's true that many European firms, especially German firms, are moving both to the US and to China to produce there. But we do see that China is starting to specialize in these sectors in which the euro area has a competitive edge, either because of industrial policy or production subsidies. So we do see that a lot of these exports that are coming from China, whereas we are losing access to the Chinese market, are coming from that. Now, on Piero Olivier's point, it's true that not all concentration on products. Not all products have the same risks. We're aware of Isabel's work, but here we're showing that these dependencies are coming on critical inputs. So for example, we saw high levels of concentration on sectors like solar panels, ADP machines. These are sectors that are key for the digital and green transition. So these are sectors that the euro area cares about. Then on the question on resilience and what is the most important area for deepening internal market integration, here we push a lot for having integrated capital markets, because that's going to make the allocation of capital better. That's going to channel funds towards startups that now are going to the US to look for venture capital, and that potentially can create innovation. So that's what we are basically emphasizing in the paper. Now, if I may make another remark to Diego's point on the COVID, it's true that during the COVID pandemic, the problem was not just supply chain disruptions. It was the fact there was a huge demand shock at the moment in which there was binding capacity constraints, and that's what created inflation, and that's what you have shown in your paper with your co-authors. The world is a bit different now, and here I think that the risks are facing persistent supply shocks that may come through disruptions.
All right, let me move to the right, Helen, and then the lady down there.
Thank you very much. Ellen Ray, London Business School and CEPR. So while I agree fully with Piero Olivier that we should not worry about castor oil and electrical blanket, however, I think I would like to put a little bit the spotlight on the global commodity markets, and so the impact of China there. Well, we are seeing some differential importance now of different commodities. We are moving a little bit out of fossil fuels and we are going into electrification, which I think we'll all agree is very important for the future of energy security in Europe. And if you look at all the materials which are listed actually by the IMF as key for the electrification process, and you look at the centrality of network and the centrality of China in these networks, you will see that in the last 15 years or so, the centrality of China has become extremely important, and that does look like a strategy. So much so that these networks, unlike the fuel network, which are more distributed, they look a lot more now like a hub and spoke, with China in the middle as a key processing node. So I think, from the point of view of Europe, this is definitely something that maybe we should focus on a bit.
Yes.
Beata Jaworczyk from the EBRD in Oxford. I think that from the policy perspective, it's useful to separate the competitiveness challenge from the reliance on imported inputs. Yes, deeper integration of the single market is good in its own right. It's going to help with competitiveness, but it may not help with the access to some of the critical raw materials. Think about rare earth. 10% of known reserves of rare earth are in Western countries or countries aligned with the Western Bloc. And some of you may recall that we talked about this last year in this room. So in this case, this deepening of the single market will not do the trick. Right? What about other inputs? I think if you believe that the EU is less exposed to shocks and disruptions than other places, then reshoring makes sense. If we are more or equally exposed as other places, then we would want to diversify. Right? The problem is if production sources, like in the case of solar panels, are concentrated, then you want to stockpile. And I think in many cases, stockpiling may be an answer. Thank you.
Okay. Why don't you answer to these two, and then we move to the left and we close, please.
Yeah, no, I completely agree with both Hélène and Beata's point. So on Hélène, that's true, the centrality of China, and this is something that we see with other critical minerals, has increased substantially. We are not looking at the global commodity markets. We do look at rare earths, and as Beata was saying, we do see that China is dominating the processing and the extraction of these rare earth metals. This is, and we actually have something on that in the paper. We see that the euro area is relying on these rare earth metals that are coming from China, and the concentrations are quite high. And this goes back to this paper that I was mentioning during my presentation, the paper by Laura Alfaro, where they show that these export controls that were introduced by China actually foster innovation in other countries, both by increasing size and by deepening market integration.
So I have nothing to say about rare earth, but we have to be serious about which side we are. Like, are we for the green agenda or are we for protection of special interests, okay? We cannot argue that we want to push the green agenda at the same time, like, put tariffs on Chinese solar panels and electric vehicles because they are too cheap for us. So we have to, if we are going to push for the green agenda, then, we have to put that ahead of the special interest and accept the gifts of China in terms of, like, cheap electric cars and cheap solar panels, because that's going to be great for us, and get our hearts together and get our, like, charging ports in place and integrate, like, those markets. That's going to foster the diffusion. But we cannot, like, go on both sides. Like, we cannot complain about China and then push for the green agenda. There is a clear trade-off. We have to take one side.
Great. So next I have Yanis and Oscar. Please, Yanis.
Thank you for the thought-provoking paper. I think one of the strongest laws in economics the last 100 years is the law of comparative advantage. And if I'm correct, it is still valid with all the modifications. So we have to be extremely careful when we say that a country like China is emerging, is innovative. This is not a reason to have trade restrictions. I mean, humanity has benefited from liberal trade in the last 100 years. So if we want to impose tariffs, we must have a very serious reason. Up to now, I haven't heard of any serious reason. I mean, that China is innovative is not a problem. I mean, okay, if we have in mind strategic arguments, this is another story. But if we're based on trade theory and trade practice, we have to be extremely careful. By the way, you have portrayed Europe as being in the middle between the two mythical monsters, Scylla and Charybdis. On the one hand, we have tariffs for the United States. On the other hand, you have the strategies of China. So perhaps you give a way out in the second part of your lecture when you showed that the intra-Europe constraints are equivalent to a tariffs of the order of 70%. So by eliminating these tariffs, we liberalized trade within Europe. So also that gives an answer to the first lecture that we had, why non-banks are investing abroad. They are investing abroad because the rate of return of investment in Europe is rather low because of the constraints you have portrayed and because we don't have enough liquidity, we don't have enough safe assets in Europe. So I prefer the second part of your lecture as more constructive rather than the first one, which contradicts the predicaments of free trade. Thank you.
Oscar, and then, I'm sorry, I have to close too many. I'm sorry, Oscar, and then we are running out of time.
Thank you very much for the very nice paper and the discussion. So one of your key recommendations, Ana Maria, was that Europe should foster investment. We should invest more and better. I would agree with that. But I guess the key natural following question is what kind of investment, what kind of a strategy should we follow? And I think you can distinguish here two kind of clear, different models or strategies. One possibility is that we keep investing to maintain our export orientation. And the question here is whether do we want to become more like China? Or else the alternative is to foster more domestic final demand. That is, do we want to become more like the US? I guess this is a key question, and depending on the answer you provide to this question, this will have profound implications for some of the debates that we have had. No? This is certainly crucial for the previous discussion on the financial sector, the capital markets union, and so on. As Vítor Constancio rightly said, if we insist on an economy that is oriented towards exports, we will always be a net lender, and no matter how well we do in the financial sector, we will always keep exporting capital to the rest of the world, and probably to the US, most of it. I think it's important to make this discussion at this point, especially because one of your key takeaways is that we are becoming more and more reliant and vulnerable to supplies of critical materials and all these things. This is certainly the case with energy, but the main vulnerability, the main dependency for me is external demand. We are still so much dependent on external demand that this is probably should be the key focus of vulnerabilities. Thank you.
So I don't think, I mean, please, if you want to comment, but those were more comments than...
1 minute.
Yeah, well, much less than so. 20
seconds. Okay. So, Yanis, to your point, I think that was the key message of our paper. The first part of the paper is saying it would be great to have efficiency. Trade is good. We're not advocating for tariffs. But we're in a different world now. We're in a world in which there's geopolitical tensions and there's geopolitical risks. So now we have another factor that we need to take into account, which is resilience. Now, what is the solution? That's the second part of our paper, as you put it correctly, is opening the internal market, reducing these tariffs that we have estimated. So these two messages are connected. Efficiency is great, but now we have geopolitical tensions. It would be great to open and take advantage of the scale that we have in the internal market. Okay.
Diego?
Nothing to say.
Okay. So finally, we can close. My own conclusion is don't blame others. Don't blame free trade for your problem. Put in order your own house. This is my humble personal conclusion of this debate. Thank you to all for the rich discussion.